everyone, very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is your daily 1 hour long dose of personal finance. We've got lots lined up today. It's an action-packed day right here on The Money Show. First up, we will be talking about, how to create your own stimulus check. Remember that around the world, governments have been issuing stimulus checks to individuals. Well, guess what? You don't need to depend on that. We'll help you craft your own stimulus check by helping you decide and, sort of generate alternative streams of income, creating an emergency fund and helping you tide over a crisis, and recommend any chops or changes that your investment should make to deal with the crisis. Later on the show, we will be bringing on board Mr. Balasubramanian, the CEO of Aditya Birla Sunlife, and he will help you decide on how and when and if you should increase your mutual fund SIPs. And in our Spend with TMS segment, we will be bringing on board Sankalp Agarwal, the co-founder and CEO of Travel Triangle, to talk about what exactly are these air bubbles. And now that we have an air bubble with Maldives, is that your best option for a quick getaway? Well, first up, let's talk about a very interesting report that has come in, and this time around it's come in from LinkedIn. They've done a study on what sort of jobs are available, and it looks like there are certain skills that are mostly in demand. Some of the most interesting skills include well, you guessed it, it is with respect to coding. Among many of the things, there is this heightened activity when it comes to that. JavaScript is one of the most watched out for jobs on demand, in demand on LinkedIn. But mind you, competition as well has increased quite significantly. In fact, competition for jobs has doubled compared to 6 months ago. The decline stands at 15% for the period ended June. And like I mentioned, top skills, I'll just get to that as well in a bit. But the number of applications per job has actually doubled from January to June 2020. That means for every one position that you may be scouting, there may be many more people who may be looking out for the very same job. The update highlights also the hiring rate in India. The overall hiring sentiment at this point of time, the competition for securing jobs as well, is in demand. So while there has been a bit of a rebound in hiring after the unlock phase, it's going to be slow because still we are in the midst of economic uncertainty. So overall hiring has declined by 50% in April. The decline stands at 15% for the period ended June. And unsurprisingly, travel and recreation are the two sectors that have been hit the most, with the average number of applications posted per job on LinkedIn is increasing from 90 in Jan 2020 to 180 in June 2020. So like I mentioned, if you've applied for a job, there will be not 90, but perhaps 180 people that will be applying for the very same job. Now, the top 5 in-demand jobs and skills also include software engineer, business development manager, sales manager, business analyst, and content writer. These are some of the 5 in-demand jobs, and the top skills in demand also include JavaScript, SQL, sales management, team leadership, and recruiting. So folks, buckle up, and if you do not have any of these skills, if you are at this point of time maybe in the middle of jobs, you could perhaps polish up on your skills, and these are the best, some of the best skills that are in demand. Not very difficult as well to pick them up. I mean, there are so many online courses. You've already heard of Unacademy, Udemy. There are so many such online websites where you can brush up on these skills absolutely online with a very small fee. Okay, folks, so while we leave you scouting, sort of looking for all of those skills online and where you can learn them, it's also important, of course, to understand what you should do with your mutual fund portfolio. I'm sure many of you, unfortunately, may have had to either trim down your SIPs to adjust your, portfolio because to the cash crunch that you may be facing, or, you may be thinking that equities are really not doing much, so let me just redeem some of my mutual funds. Well, let's understand this conundrum then if you may be facing with Balasubramanian, the CEO of Aditya Birla Sunlife Mutual Fund. Mr. Bala, many thanks for joining us today on ET Now. Like I mentioned, a lot of people today have either ended their mutual funds, that means redeemed their mutual funds, or they've just stopped, doing their SIPs either because of the cash crunch, or they're very disappointed with what the mutual fund industry has delivered in terms of returns. So why do you think mutual fund investors should get back on the SIP path?
See, SIP is something, while we have seen the trend in the last 3-4 months, the new trend that had got emerged, people, as you rightly mentioned, they have just paused it only because of the uncertain time. So therefore, let me keep the money in my bank balance rather than continuing investment. Given the fact that in what way the future will shape up and so on and so forth. This is, of course, the common concern which comes in everybody's mind. But having seen that, also admit and accept the last 6-7 years, mutual fund industries, including ourselves, did a great job in building SIP as a book and SIP way of investing. Is the SIP way of investing to build your longer term purpose for which you are making investments, which is nothing but a goal-based investment that one has got. And every individual invest in SIP only with some kind of purpose, keeping in mind how much they should benefit out of it, either for buying a house in the future, or for marriage expenses, or for the purpose of buying a car and building a house, planning for my travel expenditure, education, and so on and so forth. There are many purposes for which everyone makes an investment. Therefore, the purpose on the back of COVID, has it gone off? Absolutely no. Actually, on the contrary, it got actually, one has to pay more attention, SIP way of investing post COVID-19, and given the fact that you need to still do a lot more work for building your future and insulate from such kind of risk coming on account of the COVID in the form of building your future through the SIP. That remains. But they have only seen the small trend, and that's something it is bound to be there for a few months. Given the fact that the industry has grown quite substantially in the last 4-5 years, we'll probably see the SIP way of investing is coming back as we move forward. Given the fact that one other question which comes from people who want to now invest now, the common question which I get from people is that should I invest in SIP for 3 months or 6 months, given the fact that the market has gone up quite substantially, and also everyone wants to actually put money back in the market, having now missed this rally of 20-20% uptake. At the same time, also nobody wants to put a higher end of the market. So that's common question that comes, that what should I invest? How should I invest in SIP now spread over 1 year or maybe a 3 months kind of question which comes in. Therefore, when this kind of question comes, I would assume SIP, the purpose remains, the goal for which you are making investment on SIP remains. At the same time, the market, in the equity market, provides a greater wealth creation opportunity in the long run. That fact and that acceptance also remains. And that's being the case, I'm very confident SIP way of investing would come back.
Okay, understood. You know, Mr. Bala, the one trend that we are observing, especially in this market rally that we've been witnessing, or the recent market rally that we witnessed, was the way mid and small caps came back with a lot of fervor. Do you believe, and mind you, that this has also finally led to some bit of optimism on mid and small cap funds finally doing well, because obviously in the last 2-3 years, mid and small cap funds have lost out quite a bit on their NAVs. So do you believe now with this, rally that we're seeing in mid and small cap indices, one should increase their SIPs in mid and small cap funds?
Of course, it makes sense given the fact that the smaller mid cap sectors, though it has bounced back in the recently, one should also accept the fact that the last 3 years and 5 years, especially 3 years, smaller mid cap has been the big underperformer to the market, and that has actually left a huge gap between the large cap performance versus the smaller mid cap performance. That itself makes a case actually for this to with respect to the giving return to the investors. And also having seen that in terms of valuation, smaller mid cap companies also got hit very badly, and there's also, if there is a broader market recovery comes in from the economic point of view, then actually you'll see a greater participation coming from the smaller mid cap companies in the long run. So therefore, it makes sense actually to consider smaller mid cap as sectors for the SIP. But the point that you made earlier, that smaller mid cap seen a smaller outflow, while one has to look at this inflow outflow with respect to the size of this category. The size of the category today in the industry is large cap is the largest category. Then comes a multi cap. Then comes the balance fund category. Then there comes actually the smaller mid cap category. But smaller mid cap category in relation to the various categories of mutual funds, equity schemes that we have, is smaller. Therefore, the number what you're mentioning may look smaller, but one has to look at this number in relation to the size of that segment.
You know, Mr. Bala, we are unfortunately seeing a lot of companies struggling to cope with this pandemic, leading them to default on some loans. That in turn is also leading to downgrades. That in turn is affecting the NAVs of, I mean, of course, the bigger impact is usually felt by debt funds, but it does tend to impact equities and consequently the mutual fund NAVs in the equity markets as well. So obviously it's something that has caused a lot of worry among investors. We get a lot of queries as well with respect to the same right here on the Money Show, and I would like to address that. How would you assuage investors about this entire bit?
See, I think from an investor's point of view, while the concern that came in the year 2018-19 was one of event that happened post 2018 crisis, and that's one thing which is very small in nature compared to the size of investment that we all make. What happened, an accident that happened the year 18-19 due to the credit event, that's one of the small accident happened. But having said that, in order to ensure that the market stability is maintained and the mutual fund is able to actually function properly in managing the rest of the asset classes. So as I mentioned, the small as a percentage of the total asset that we all manage, whether it is segregated mandate or any credit issues, will be a small percentage of that particular schemes. But in an overall thinking, if you see, it's very small in size. But having said that, from investor's point of view, any small is also big. Therefore, only the way I think they can actually get over this hangover is one, they have to accept this one-off kind of event. And second is the individual losses would be there, is very marginal. Therefore, as and when we see the economic recovery coming back, therefore, segregated mandate also would come back to some extent in terms of recovery, may not be fully, but I think there will be some recovery which will come. And to the extent whatever the recovery comes, one has to accept that as only that much one could get it. At the same time, the rest of the portfolios are doing well, and providing a greater experience to the investors in the near term. I think it again changes from time to time. As long as the investors comes with an acceptance that I'm making this investment for longer term, say 5-10 years kind of period, this kind of small issue that comes and hits you in terms of hits the investor sentiment, that will remain as a temporary. In the long run, I think this will get corrected.
Okay, what is the screening process then that, the Aditya Birla Sunlife AMC as a whole, the mutual fund house as a whole follows, before they pick stocks for their, for the variety of the funds that they have?
Yeah. Now, at Aditya Birla Sunlife Mutual Fund, clearly there's a set process, there's philosophy that we have in terms of screening of companies, both in fixed income and in equity. I think first and foremost comes with respect to the governance, the way I think the companies are run. Second, of course, with respect to the earnings, how companies have been reporting their earnings, including the disclosures that they make. And finally, all these companies have to have the longer term sustainable business model in order to ensure they are able to create shareholders value. At the same time, they are quite clear about how the balance sheets are being constructed with respect to the right mix between equity funding and debt funding, and also the future, the growth prospects in which the companies are participating. I think all these things are very important when it comes to the question of building our screening process and selecting companies, both in equity and fixed income. That as a fund house, having been part of the industry for the last 25 years, and every time we get a new learning, on the basis of new learning, how they incorporate as part of the risk management practices, and then keep building our portfolio. And that's why we are managing close to about 250,000 crores of assets under management. We are managing it purely as built on the base of the research-driven process that as a AMC has built over a period of time.
Okay, just before we let you go, Mr. Bala, if I had to sort of talk about, how would investors allocate their money, not just between equity and debt, but also within the equity category. You mentioned in your previous answer, there's large cap, mid cap, small cap, multi cap, balance, so on and so forth. How would you recommend they essentially go about allocating their money across the various asset classes?
Interesting, Mobina. I think I'm a firm believer of asset allocation. So whatever one may say bullish on equity, bearish on debt, bullish on durations, bullish on credit, bearish on credit. These things will keep happening around the year. But that's situational. At that point of time, what you think is right, given the fact that there are some indicators that are reading it on the basis of you're making a bullish case and bearish case. From an investor's point of view, cannot actually keep doing this kind of exercise all the time while managing the portfolio. Therefore, I always believe that 4 concepts in mutual fund exist. One, there is a purpose for which you save your money. That is for the purpose of creating liquidity, which is the equivalent to savings fund like liquid fund. And second is for creating income. That's why I think fixed income scheme comes over a period of time. You want to generate income as an alternate to a fixed deposit to some extent. And the third, of course, is with respect to the wealth creation, what I mentioned earlier, with SIP, we are building book size. That's for the purpose of building a longer term wealth creation as a purpose. And third is actually tax planning, which is nothing but investing in ALS schemes to benefit out of Section 80C benefit. These 4 components are extremely important while managing the portfolio for every investor, irrespective of whatever the size of the investment they make. And these 4 components remains constant. And as long as one stick to the 4 component, and then put your money a little bit on all the 5, and then go overweight on one which is a longer term, and go underweight on the one which is short term money, and then build this kind of process, then definitely on a holistic portfolio, the investor experience will be very good. The investor experience, I suppose, goes for a toss and becomes more volatile only when you actually allocate your money overweight on too much overweight on equity, and too much overweight on fixed income or credit funds or gilt fund and so on and so forth. Then only I think you end up in a mess. And all of us face this problem. Therefore, to maintain the discipline of this concept of investing for the purpose of savings, income generation, wealth creation, and tax planning, and all the schemes that are provided by the mutual fund, I think if you're able to make allocation, I think the experience can be a lot better.